Liquidity is king, an adage in trading circles, is an apt way to describe its importance. It describes a market's ability to facilitate conversion between an asset to fiat currency. Poor liquidity around an asset leads to market inefficiencies where traders lose money due to events like thin order books, slippage, and larger spreads. It can also cause serious volatility and deter sophisticated investors from placing trades. Kaiko's head of research Clara Medley told Decrypt that the current situation is pretty dangerous and could manifest in massive price volatility in both directions. A drop in liquidity certainly helps traders to the upside, but there is always eventually a downside, said Medley. The moment buy pressure subsides, anything can happen to price. Welcome to this Crypto Wave channel. Watch the full video to learn more. Crypto's liquidity crisis. The liquidity crisis first manifested with a $200 million drop in 1% market depth after Silvergate's SEN network was closed, as identified in Kaiko's latest research note. The 1% market depth is calculated by summing the bids and asks within 1% of the mid-price for the top 10 cryptocurrencies. If the market depth is sufficient and order books are crowded around the market price, it reduces the volatility in the market. The market depth for Bitcoin and Ethereum is still down 16.12% and 17.64%, respectively, from their monthly opening levels. Kaiko analyst Connor Ryder wrote that we are currently at our lowest level of liquidity in BTC markets in 10 months, even lower than the aftermath of FTX. The liquidity crunch is also causing inefficiencies such as high slippage and larger spreads. Coinbase's BTC-USD pair currently exhibits nearly 3 times higher slippage than at the start of March. The need for fiat on-ramps. The market share of fiat dollars and stablecoins has also drastically shifted, with stablecoin volumes on centralized exchanges rising from a 77% share of volumes to 95% in just over a year. The trend accelerated swiftly after the closure of crypto banking networks. While shifting to stablecoin trading pairs does not create an issue for medium to small-scale investors, it can become a problem for more sophisticated traders. Medley explained that USD networks are essential to traders who are required to settle their traders daily. Stablecoins are not ideal from a risk management perspective, especially to settle at the end of the day or week, she said. But if banks close and don't process transactions, then stablecoins are the next best alternative. The ALAMEDA factor. Further crimping liquidity, Binance, the world's most liquid crypto exchange, ended zero-fee trading for nearly all its Bitcoin trading pairs last week, hitting market makers' ability to charge higher fees for executing trades on the platform. Liquidity for the Bitcoin Tether pair on Binance has dropped 70% since the announcement, while trading volumes have fallen 90%, according to Kaiko data. The vanishing liquidity can be traced back to the collapse of Sam Bankman-Fried's FTX exchange and hedge fund ALAMEDA research. ALAMEDA was one of the biggest liquidity providers in the crypto industry, and its bankruptcy left a void that has been exacerbated by the banking sector turmoil of 2023. While most market participants expect new contenders to gradually emerge to perform the network functions of Silvergate and Signature, they say complete replacements are unlikely to pop up overnight. Until then, liquidity is probably going to get worse and worse, said Joseph Edwards, investment advisor at Enigma Securities. Furthermore, it's not just market maker trouble that's crunching crypto liquidity. Despite Bitcoin's recent rally following a lengthy downturn, many investors are still trading cautiously in the wake of the banking crises and rising interest rates, some specialists say. Subscribe to our channel to keep up with new content. Your support and feedback are much appreciated.